All right, everyone. Happy Thursday. This is Jason Jacoby here, your principal and wealth advisor at Boyer Financial Services. Just want to do another quick video here for you. I know market's been crazy, well, the last 4 months, but especially yesterday. The Dow Jones fell over 1,164 points, 1,164 points, representing a 3.57% drop. The NASDAQ was off 4.73%, and the S&P shed about 4.04% yesterday alone. Lots to digest. What is the difference between day-to-day movements? Why some days up? Why a lot of days down right now? What does that mean? Nothing's really changed day to day. You get a lot of emotion in the markets trading. You get some hedge funds that have been pretty risky. Again, hedge funds are for sophisticated and accredited investors that have tons of money that are trying to outpace benchmarks in performance. And they take a little bit more risks. They invest in derivatives, options, futures contracts, a lot of different types of investing than the traditional investor. A lot of them are de-risking right now, obviously, just don't want to suscept their clients to too much risk at this point, just with all the volatility. So that's a lot of the reason for a lot of the big declines on some days. But also, yesterday, there was some news came out from U.S. retail behemoths, Target and Walmart and Lowe's. So again, those are kind of your consumer-driven companies. Kind of gives us a pulse and a heartbeat on the retail spender, where they're spending their money. Are they spending their money? What's going on? So they came out with disappointing earnings. Because of inflation, it's hard to get products because China keeps locking down their country. So people aren't working, they're locked up in their homes, or even some people are locked up at their offices away from their families in order to make products or do their work to try to get stuff out. So that's causing another ripple in the supply chain that we saw easing up a little bit. As a whole, things should continue to ease on that front. Again, from my last video, I was optimistic on the fact that inflation ticked down to 8.3% from March's 8.5%. Still believe that to be true over the next year or so. Again, especially as we head into Q3 and Q4 of this year, hopefully we continue to see that ease up. That'll give us a better idea about the whole recession thing, which again is because of yesterday, people are even more fearful of a recession because less people are spending their money. But that's just the retail sector, which I believe the retail sector only makes up about 3 to 4% approximately of the S&P 500. So again, it gives us a gauge of retail spending, but again, I'm not going to get overly concerned. Again, it's my job to maintain composure and calmness in this time. Again, a lot of people are emotional, so we got to take the emotion out of it and look at the facts here, right? And again, recession is possible. We said that in the last video. It's nothing to be afraid of. We've always preached long-term mindset. Again, everyone's long-term is different based off of time span, cash needs, income, whether it's growth or capital preservation or a mixture of both. Dividend payers are shining right now. But again, it just depends on an opportunity, the type of investor you are, what you're looking for. But again, as a whole, we've been preaching, hey, take the emotion out of it. The stock market is the only marketplace that when it goes on sale, people run out of the store screaming. Again, I'm going to keep preaching that because, again, look at Black Friday. You've seen all the crazy videos online, people talking about and showing videos of people fighting each other, getting beat over the head with baseball bats, plastic ones at like Target or whatever it may be, or toy stores, or pushing each other over aisles to get to specific toys, and because they're all on sale and discounts. But again, this is the same thing. This is a market where you can invest in some of the world's and America's specifically greatest companies that are going to be innovative, that are going to be changing the game. That again, their main goal is to appreciate capital and return that favor to their shareholders, and pay off their debts and basically make sure that American ingenuity stays at the forefront of the world, right? That's the whole goal. Now, looking at the markets, again, I'm going to kind of share my screen here in a second. I want to look at the markets where we're at pricing wise. So let me share my screen here. Bear with me 1 second. We're going to share desktop 3. Okay. All right. So let's take a look at this. Okay, guys. We're going to take a look here. So desktop 3. And sorry, I'm getting used to all this stuff here. But all right. So a few things we want to look at yesterday. This is what we just talked about right here. All right. The amount of the markets fallen the last yesterday alone. Now, it's the 4th time in 2022 that the Dow has fallen more than 900 points, to put that in perspective. 4 times this year, something that has not happened in 2021, didn't happen at all. And of the 12 times that the Dow Jones index has ever fallen 1,000 points, 2 of them have happened this month. It's kind of crazy, right? The NASDAQ now down nearly 28% for this year. S&P 500, again, top 500 companies in the country in terms of market capitalization size is off about 18.2%. So again, bottom line is retail results yesterday from those 3 companies, Target, Walmart, Lowe's, is basically showing our worry about inflation and that our inflation-defying act of consumer spending may be in jeopardy, even if it isn't showing up in consumer data yet. Okay, just putting that in perspective. So perspective. That's what I'm going to be preaching here. All right, so this is a list right here. Dow Jones, S&P 500, NASDAQ yearly return comparison, okay, from 1975. Dow Jones, first column, S&P 500, second column, which we just talked about, NASDAQ, the tech stocks, third column. So again, year by year, again, we're going to have red years, right? 2000, 2001, 2002, the tech wreck, the tech bubble. We're seeing similar behaviors in the NASDAQ and the tech market this past year, the last 3 years really, which I'll talk about. But again, we have down years. September 11th, tech bubble burst, caused a lot of disruption in the markets. So again, you saw the numbers on the right-hand column, which is the tech stocks down way further. And then end of the decade, 08, 09 happened, right? 33%, Dow Jones, 38%, S&P, 40% NASDAQ reduction. So basically we call it the lost decade, right? Because you had 3 years of down markets in the beginning because of September 11th, tech bubble burst, things of that nature. And then some good years in there, again, 50% rally off the lows. And then by 08, 09, recession, again, CMOs, which are collateralized mortgage obligations. Go watch the movie The Big Short if you want to kind of learn more about what happened in 08, 09. I'm sure you personally remember. That's why the R word scares you so much, recession word, because everyone remembers 08, 09. Worst time in our lifetimes, at least, since the Great Depression, okay? So putting that in perspective, no safety in 08, 09. Bond markets were in the tank. Stocks were in the tank. Consumer spending in the tank. Lots of people lost their homes, their jobs, their livelihoods, right? There was no safety. The banking system forever changed that day for the good, for the good. So as we go through that next decade, some red, again, great years. What I really want to focus on here is 2020. This is COVID, right? March 2020, the quickest, largest stock market drop. So in terms of speed of market decrease, deflation in the market happened in March of 2020, went down 35% in March. Within a few weeks, markets were at the bottom. Fastest decline since the Great Depression. Again, we've had big market drops, right? 40%, 39, we've had big declines, but in terms of speed of decline, it was the largest. Now, but look, if people hung in there in 2020, the market's actually rebounded by year end, 7% up for the Dow Jones, 16%, 43% for the NASDAQ for tech, which is incredible, right? Because we were in a recession in 2020. So coming out of recessions, tech tends to do the best, the growth-oriented companies, because economies are picking up, people are starting to get back to normal, spend money. So tech is kind of always the forefront of that. And then they get hit the hardest going into recessions, right? Because think about companies that have less cash on hand. Again, this is just for your startups, your tech, your forward-thinking companies that borrow lots of money, that have that are paying interest on the money they're borrowing from the banks. Basically, they get hit the hardest because as interest rates rise, banks charge more interest on loans. That means less of a bottom line for them. So that's why tech as a whole gets hit the hardest pre-recession or in recessions, but they bounce back the most. So keep that in mind. And then obviously bouncing back into 2021, the market's been incredible. So technically for the last 3 years, right? If you're in the NASDAQ, you almost made 100%, right? 60% approximately, 40% approximately the Dow Jones. So the markets have been on a tear. So again, I want to say this for perspective, people, perspective. I'm going to show you something else real quick, okay? This is the S&P 500 index daily chart. This goes back to 2020, September of 2020. So after March, right? We had a great end of fourth quarter here. Fourth quarter was very strong. First quarter turned over. Again, we had some losses here. Again, bear markets, corrections of 10% or more are normal. Let's keep that in mind. It happens at least once or twice a year. Now, look at the market from this point, though, from 2020. Yes, we've had dips, but look at pretty much straight up, okay, till October of 2021 for that next year. Then we have an exponential increase right here heading into November, end of 2021. So from October to November 2021, incredible. Markets kind of peaked a little bit. We had a bit of a pullback here, right? And then markets finish at all-time highs that first week of January. And then, so the saying that we always said in the beginning of January was, as the first week of the new year goes, so the rest of the year. Well, that wasn't true, was it? Because again, inflation fears, the Fed was too far behind the 8 ball. They didn't raise rates sooner. They should have been raising rates in here, possibly even let the economy suffer a little bit, not injected so much free money into the markets. Thus why the market increased so much. In this time span, 2020 and 2021, people had more cash on hand and they saved a lot more, which is good because everyone remembered 08, 09. So there's a lot of cash on hand, which is a good thing, right? So my point is perspective, 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 perspective. Investors tend to get greedy when markets are good like this, right? Investors tend to get greedy as we go up to highs here, okay? Look at this. People get greedy. People want to be a part of the market. They want it to increase. What I want to bring it down to is where we're at currently. Look at this. This is the worst 4 months we've had since 1939, okay? Since post Great Depression. That's crazy, right? But to put it in perspective, if you were a long-term investor, which again, we always encourage having a long-term mindset, where we're at now, we're only back to March 25th of 2021. So a little over a year ago numbers, okay? So technically you still would have had made money off of March 2020 lows, okay? So again, perspective, yes, the markets have fallen almost 30% in the NASDAQ and almost 20, hovering at 20% here for the S&P and Dow, right? Which is bear markets. That is possible, okay? We could continue to fall a little bit further. You know, we could get down to this level here, which we call support, our next support levels. If it continues to break this line right here that I'm kind of highlighting, could happen, right? But again, my point is to stay the course. I mean, look at the chart again from 2020. You got to stay the course. Again, you know what type of investor you are. Again, if you're a short-term investor, you shouldn't be in the markets. We always preach that. But again, having a mindset and taking the emotion out and just letting it ride, not trying to time markets, not trying to time getting in, getting out, which diminishes your returns in the short term and specifically over the long term, your compound interest. You just got to hang tight sometimes. Remember the last video I had said, hey, we really need to make sure that, you know, with that long-term mindset, that we stay the course. Sometimes the best move is no move, okay? So we have to let this play out. We got to wash out the worrisome investors. And again, if we look at the NASDAQ, it's way more volatile at this point, right? Again, we're back down to again, October, November 2020 numbers right here. So again, still higher than March 2020 numbers, but again, because of tech, everyone was investing. I compare this to the tech bubble of 99, 2000, 2001, because then you remember, if you're a seasoned investor or individual, everyone was like, oh, we're buying tech, I'm buying the startup, I'm buying the hot pick, the hot stock. And they were making money hand over fist, not for any specific reason. There were no earnings. There were no, ironclad balance sheets with lots of assets, low liabilities, strong cash flows. There weren't any of that, right? They were just buying stocks, and the stocks were going up because it was a feeding frenzy and everyone wanted to be a part of it. That's what the last 3 years for tech has felt like as a whole. Again, there is super quality names in tech. I could name a few of them. Not going to here for just specific purposes, just trying to keep this broad level, but there are still tech names that aren't going to perform like the NASDAQ, like the normal tech stock here, because they have ironclad balance sheets, because they pay dividends, because they're at the forefront of innovation. They can be all of that. But my point is, as a whole, the index as a whole, as tech as a whole, acted a lot like the tech bubble bursting in 2000 and 2001. Everyone was trying to find the hot tech stock, was making lots of money, thinking they were stock pickers. Well, we saw that not to be true, right? Again, so if you take the emotion out of it, you ride the wave. Unfortunately, it hurts, specifically because bond markets have had the worst year since 2008, since the Great Recession. So there's really no safety in a traditional portfolio. But again, staying the course. Inflation we should see tick down here. There are going to be specific areas that aren't going to see tick down in inflation over the next few months, specifically probably food and gas, which stinks. But hopefully at least we can get the more broad-based inflation under control. Supply chains continue to reopen, and so on and so forth. So again, my whole point with this video, again, I apologize for the length of it. I talk a lot. I know, still tired, still working out with the toddler and studying and making sure that all the clients, all you guys are good, and then taking care of the wife from her C-section and the newborn. But life is good. Again, count your blessings. Your true wealth lies in your friendships and your families and your relationships. The markets are going to be okay. They always bounce back, right? That chart just shows you that. We have big highs, we have lows, we have hard times, but we're going to get through it. We could be near a bottom, specifically if inflation starts getting tapered, then that's great news. Then you could see the markets participate in a huge rally. So that's the whole point. I'm not trying to time it. If we go into recession, markets could stay down for 15 months or so. Specifically, we could fall down the average if a recession and extreme inflation coincide. Markets tend to go down about 35% as a whole. Again, that's broad-based, not every stock, but as a broad index. Looking at the whole market, goes down about 35%. NASDAQ's almost done that. Dow and S&P still have a ways to go. Again, it might not, but that's a possibility. But if you hang in there, again, weather the storm, have a long-term mindset, you're going to be just fine. Again, especially as we go into quarter 3, quarter 4 election time as well. So hang in there. Again, let me know if you need anything, but I just wanted to kind of nip this in the bud a little bit, show perspective. Don't be greedy in up markets like we've had the last few years. It's put it in perspective. Know that there's give and take, there's ups and downs, there's new highs, lows, but stay the course and you're going to be okay. All right. Let me know if you need anything. Love you all. God bless. And we'll talk soon. Thanks.